Mhm.
Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I will be your moderator for today's webinar, Opportunity Zones 2.0, Expansion of Tax Benefits from the OBBBA. Our presenter today is Jeff Feinstein. Before we get started, I wanted to go through some housekeeping items and do some technical checks just to make sure that everything is working. First, if you don't mind going to the Q&A tab on your control panel, and please let me know that you can hear my voice and see the title slide. Feel free to let us know one thing you'd like to learn from today's webinar. If anyone has any technical issues today, please let me know in that Q&A tab, and I will do my best to get around to everybody as quickly as possible. This is also where you can post your questions and comments for our presenter. And I see them coming in now in the Q&A here, fast and furious. So thank you so much for letting me know that everything is working. Now that we know that, let's go through some housekeeping. This webinar qualifies for 1 CPE credit or 1 CE credit. CPE credit will be available within 24 hours in your CPA Academy account. And for attendees with a P10 on file, we will upload your CE to the IRS at a later date. You'll earn that credit today by staying logged in for 50 minutes and answering the poll questions. There will be 5 polls, and to earn credit, you'll need to answer at least 3 of them. I also wanted to let you know that we're recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy account within 24 hours. And if you have to log out or log back in for any reason, our software will also keep track of your time. We also recommend you download today's presentation materials, which can be found in the control panel's Handouts tab. So now that we're all set, let's welcome our presenter. Jeff, the floor is all yours.
It's a pleasure to be here. I understand we have a very, very large crowd gathering here, not a crowd, audience, I should say. And it certainly suggests how topical and important the new legislation enacting now Opportunity Zone permanence is to the practitioner community. So I am looking forward to informing and educating. I am not a CPA. I'm speaking to experts in the category, but I hope that we can illuminate the power of the Opportunity Zone legislation, give you some historical perspective, compare it to the existing legislation still enacted and available and actionable by your clients, and we'll talk about some scenarios, and of course, describe in full detail what we're calling Opportunity Zone 2.0, the new permanent feature of the tax code. Appropriate disclaimers up front. Again, I'm not a CPA, but the co-founder and managing partner at Pinnacle Partners, we have been exclusively executing on the Opportunity Zone legislation since 2018, when it was enacted part of the TJC in 2017 as a temporary program. Our firm has a substantial track record, which I will refer to in a moment, and this is our current agenda. We'll ensure this is very interactive. We've got a Q&A queuing up. We'll look to attend to the most pertinent questions throughout the presentation. But before doing so, given that we have, I understand, over 1,200 attendees, Gabe, let's launch that first poll question and determine really where we're at with the audience in terms of fluency, prior understanding of opportunity zones. That'll help guide the rest of the presentation.
All right, that first polling question has been launched. How familiar are you with qualified opportunity zones? That poll will be open for about a minute or so, so please get those answers in for us. If anybody needs any assistance, I'm available in the Q&A. And Jeff, as I'm seeing these answers come in, our top answer by about 50% is somewhat familiar and interested in learning more, closely followed by first time hearing about it.
Oh, interesting. Okay, very good. Good. And then I think our agenda is purpose-built for the audience. And we're going to, again, speak to the current legislation and the enhanced legislation. I think we've got all the right content here. So continuing on, let's talk about Pinnacle Partners. As I mentioned, This is very important. I want to distinguish who we are and how we participate and execute on the opportunities on legislation. First, a couple of quick vital statistics. We are registered investment advisor with the SEC. We audit all of our funds that we offer to investors. We've capitalized over 17 different opportunity zone projects, and we were deemed by a third party as one of the top 5 in all of the opportunity zone marketplace. And there are many practitioners, fund managers, and what we are is an investment firm. So just to give context, we are not a developer. By the way, we are exclusively delivering on multifamily real estate projects in opportunity zones. That'll become a little bit more relevant here as we talk about the program. So this is real estate investment in opportunity zones. This is all that we do each and every day. So we're quite familiar with the regulations. We attend to compliance, which is a very significant cornerstone of the OZ legislation. We deal with hundreds of investors and hundreds of practitioners and CPAs, wealth advisors, and family offices. So what we do is every day we are seeking to identify and ultimately underwrite and present to investors the highest quality opportunity zone projects within the 8,700 designated zones. Again, I'll speak to that. But we are then devising joint ventures, business plans, and ultimately projects that potentially your client could invest in if they have a qualified gain. So we are an investment firm exclusively executing on this very powerful tax advantage solution. And we do so as a registered investment advisor, audited funds, and Reg D securities offerings. So that is who Pinnacle is. Suffice it to say, we'd like to consider ourselves in the upper quartile of anyone else participating in this industry. And obviously, we attempted to influence policy as it related to 2.0. So we were very close to individuals and a variety of think tanks and groups that were actively engaging in the political process. We've been recognized, broadly throughout the industry. That's enough of who Pinnacle is, but know that we do this exclusively and we consider ourselves expert. So let's move on to the opportunity zone overview. There are a number of key elements of the program that remain and are constant between what I'll call, once again, OZ 1.0, the original 2017 enacted legislation, temporary in status, and 2.0, now permanent legislation, as ratified by the OBBBA. So the original macro objective of the opportunity zone legislation was to unleash unrealized capital gains, think stock market, passive holdings, maybe low basis concentrated stock, and give that capital incentive to realize the gain and then reinvest the gain into these designated communities. The thesis was, the hypothesis at the time, and now clearly proven to be a massively successful economic stimulant program, was to direct investment into these designated communities, and without being too prescriptive, allowed for the execution to be quite effective in the operation of a real estate investment. Now, there are OZ businesses. That's not the subject of today's presentation. There are other derivative plays of opportunity zone investing, but I will tell you that probably 95% of the hundreds of billions of dollars that have been allocated have been delivered through real estate investment. And again, that is who Pinnacle Partners is, a real estate investment firm utilizing this tax advantage legislation exclusively. So the intention was to derive designated zones based on 2010 census data. And these principally were, let's just say, lower income, higher employment zones based on, again, on 2010 census data. And if one within a zone could attract investment, then, and again, not so prescriptive as to what that investment will be, but uh, generally speaking, real estate, and in our case, multifamily real estate, apartments, more affordable housing solutions, then there would be a number of incentives provided the individual who invested that capital gain. So 8,700 zones, and this is the current maps as it's referred to, and every state was eligible to nominate zones. The governor ultimately was the arbiter, and then that was sanctioned by Treasury, and these zones were established. So if you had a real estate opportunity within a zone, it by definition qualifies as an opportunity zone project, and therefore capital that's being invested would qualify for generous tax benefits. The IRS actually did a very good job supporting this program since its original legislation in 2017. I refer you to this page. It's one of the most instructive of any of the IRS FAQ pages. So, and this has been updated as of Q2 of 2025, but 42 billion, and this is kind of a, most people consider this to be a lower estimate because there's a number of investments that are unreported. But according to Nova Gradic, who's probably the leading practitioner in as an accounting firm, a national accounting firm in federal credit programs, and specifically the Opportunity Zone, they're tracking about 42 billion of investment made, about a billion of incremental investment just last quarter. So the program's still very much in effect and still attracting investment under certain circumstances, which we'll discuss. But our estimates are there's probably about 100 billion of Opportunity Zone capital invested throughout the country in the 8,700 zones. And because of its economic impact, because of the ability to deliver more housing, generally speaking, through this particular program, there was a lot of bipartisan support to see this legislation extended, if not considered permanent, in the tax code, and that's the result we obtained in the BBB. So let's talk about the mechanics of the program. So I'm speaking to obviously CPAs and practitioners, and you may be dealing with clients or maybe specific to your own balance sheet. But when you realize a capital gain, short or long-term capital gain, you are then eligible instantly for investment into an opportunity zone. Now you have 180 days to make that investment, and we'll talk more about that. But it's from the eligible gain is a realized capital gain from any source. The sale of stock, the sale of collectibles, real estate, business, crypto, even carried interest, by the way, for those that follow that subject in 17, the carry interest rules changed in that same tax legislation. Anything held less than 3 years is considered short-term capital gain. And we see this in the hedge fund, private equity, and venture industries. And then, of course, partnership interests. So I'm a partner in a business, in a mutual fund, in a real estate transaction. Partnership interests delivered on a K1 are also qualified gains. Now, as I mentioned, you have 180 days, generally speaking, from the timestamp or the realization of the gain to qualify for the Opportunity Zone benefit. There
Hey,
is an exception. Oh, yes, please,
I'm
Gabe.
sorry, Jeff. I did not mean to interrupt you. I just wanted to let everyone know that we launched our second poll. Going
Oh,
along with
excellent.
that previous thought, what are the eligible gains that can be invested into QOZs? That'll be open for about a minute. Please let us know if you need any help. I'm available here in the Q&A. The winner right now by far, and I don't think it's going to be caught, Jeff, is all of the above.
Well, yeah, very good. Okay. Well, I'm glad we moved past the slide, and I hope everyone has learned it's from any source, including what's somewhat obscure is collectibles. So the sale of art as an example. So that gain has been realized, and there's a timestamp, and using the sale of stock, publicly traded stock, is a pretty easy one. You execute the trade, it may settle within 3 days, but we've got a timestamp here, and then let's just establish there's 180 days thereafter to qualify for opportunity zone investment tax benefits. It's a little bit different as it relates to K1s. It's a lot more flexible as it relates to partnership K1s. And so I want to make that, I want to establish that very clearly. And as an example, still today, somebody who derived a partnership gain in 2024 could amend their return. Yes, Gabe, I'm sorry. Is there
Oh,
a question?
no, I'm sorry. I didn't say anything. I apologize.
Oh,
You
oh,
are free to go.
okay,
Continue
okay.
on. Thanks, Jeff.
So at this time, we're seeing a number of investors who have derived 2024 partnership gains. They have until September 10th of this year, 2025, to invest in a opportunity zone fund in 25 to defer tax in 24. So very powerful tax shield is being exemplified in this example. And we'll get into the specific benefits, but know that generally speaking, a stock sale would be 180 days. A partnership K1 gain would most likely have an extended qualification period. And we can speak to you about the parameters associated with that. Now, what are the tax benefits that you earn upon investing that capital gain? So the first is and the most powerful, is you eliminate taxes on the opportunity zone investment appreciation or gains. So if you put $1 into an opportunity zone real estate investment, and it over time, and by the way, you're required to hold that investment for 10 years. After the 10th year anniversary, you qualify for tax exemption. So $1 goes in, 10 years hence worth $4. The $3 in appreciation is tax exempt. You pay zero capital gains tax on the appreciation of the underlying investment. This is extremely powerful. And there really is very few alternatives that provide this type of tax shield or tax exemption. Now, some of you might be familiar with 1031 exchange. That's specific to real estate sales. That does not deliver elimination until death when you earn your 100% step up. It's otherwise a perpetual deferral. QSBS, another alternative tax advantage solution for venture investing or small business investing, has limits up to $10 million and other requirements. So this is an incredibly flexible tax advantage solution that accommodates the sale of any type of appreciated asset, as discussed a moment ago, and delivers on tax exemption. So this is a compounding wealth opportunity to eliminate taxes on the underlying appreciation of the real estate. There are additional incentives. The second is no depreciation recapture. So if you're familiar with a traditional real estate transaction, you get to use depreciation to offset income during the holding period, and that's tax efficient. But at terminal sale, you need to recapture that depreciation. And there's yet another recalculation, and taxes are owed on the recapture. In the opportunity zone, because there's 100% step up, there is no recapture. So this is extremely powerful, tax efficiency on steroids, we like to say. And with the BBB provision of reinstalling bonus depreciation, this becomes even more powerful. So that's the second benefit. And the third benefit is the deferral of the capital gains tax on the original sale of the appreciated assets. So if we use a stock sale example, you sold NVIDIA for $100,000 gain, you would be obligated, assuming it's long-term, 23.8%, 238,000 or $23,000 in tax owed. You get to defer that in the current program through December 31, 2026. In the new program, you get a 5-year deferral. In the origination of this program, what we'll call 1.0, you had a 7-year deferral. But that was decrementing over time. And this program, OZ 1.0, is expiring December 31, 2026. So the deferral of the capital gains tax is rather de minimis at this time, but the significant tax advantages come from elimination and depreciation without recapture. 1, 2, 3, these are the associated tax benefits when investing a capital gain into an opportunity zone. So let's use some case studies, shall we? So I just mentioned NVIDIA. So we kind of discussed this, sold 5 million of concentrated equity position, good diversification strategy, maybe top ticked at all-time high, maybe sold a portion, not all. And let's assume they have very little basis. You invest, by the way, only the gain, and you invest all or part of the gain. You don't have to invest the entirety of the gain. Again, the flexibility of this program when compared to 1031 or other solutions, which again, there are very few that are as tax advantaged as this program, they're not prescriptive about you must invest all the gain. It's any part of it, part of the gain, multiple gains from multiple sales. You could stack them. Lots, again, a lot of flexibility, but the basis goes in your pocket, and that is tax-free. And in this particular case, if you have a large concentrated stock position, it's prudent to, one, monetize the gain. It's also could be necessary to diversify one's holdings and begin to accumulate real estate. Second example is a real estate sale. So in this case, we're talking about primary residence, vacation home, or investment property, or even we've been seeing company-owned offices being sold. It's a $2 million sale in this case. There's $1 million basis. Again, the $1 million goes in the pocket, in your pocket, tax-free, and the $1 million can be invested. Again, all or part of the $1 million can be invested. In this case, in our example, they've taken 500,000, put that aside for lifestyle expenses and invest 500,000. And then they get to defer the tax associated with the 500,000, in this example, $119,000. So this is really an illustrative and very good example. Now, this sale also qualifies for 1031 exchange, which again is a like exchange. You have, I believe it's 45 days, potentially 90 days to work with an intermediary. You're effectively exchanging the basis and the gain into the new asset. Generally speaking, those assets are what we call actively managed and not necessarily passive investments. There's no real liquidity that's obtained by the owners. And by the way, you must retain your partners if you have a partnership LLC organized. So lots of restrictions, generally assume debt equivalent to the prior scenario, but that has been the traditional way to defer taxes associated with a real estate sale. I hope you can see there's far greater flexibility with the opportunity zone equivalent. And we've listed those. I will not walk through these, but we have lots of resources comparing the 1031 to the advantages of OZ investments. Carried interest, I mentioned earlier, held less than 3 years is considered short-term capital gain. That's at 39% rates, and we've had many hedge fund managers that had a good year, and they invest all their short-term gains, shielding at 39%. That deferral becomes more valuable. Obviously, you're deferring tax you'd otherwise pay at almost 40% rates. And we find this to be very attractive in this particular community associated with short-term carried interest. Also, you might have a frequent or active trader generating short-term gains. Also, just a great kind of pair trade to consider if somebody is that active. Business sales, and I would tell you mid-market M&A, and of course, we're seeing an uptick in M&A more broadly is happening. These are massive liquidity events, and we have a number of business owners that made trades and generate, again, significant liquidity, but also substantial tax implications. The OZ is just a proven tax shield for those individuals. And in all cases, they're allocating into, in our case, multifamily real estate, which has its own merits and benefits. There's another in the world of expert practitioners in the opportunity zone tax industry. There's something called a captive quaff. I won't get into all the technical details, but Pinnacle, we offer the qualified opportunity fund to our investors, to your clients potentially. We do so with all the necessary compliance reporting required by the federal government. And generally, this is the responsibility of a institutional fund manager, as Pinnacle Partners is. However, for those large liquidity events, such as a business sale, certain practitioners have encouraged their clients to create their own quaff, which they can do. And by doing so, it gives them a lot of flexibility. It presents the same tax advantages we've already discussed. And I would contend there are probably hundreds, if not a few thousand, captive quaffs managed by individuals. We call them otherwise called self-directed quaffs. And they may have the desire to invest in their own real estate projects in opportunity zones, or have maybe interest in certain businesses that could qualify in opportunity zones. But I raise this subject. It's again, it's fewer instances in which the quaffs are created for the individual or family. But we at Pinnacle have been able to accommodate these quaffs into our funds. So again, quite flexible methods to do that if somebody is in need of an attractive investment. So this would be a subject I'd say let's either deal with in the Q&A, or certainly we could discuss at greater detail. But know that individuals can create their own funds and be eligible for the same benefits, although it does require active management. So we talked earlier about the 180-day rule, and I just want to call out again case study number 6, and very specifically the 2024 gain that is still eligible for deferral and OZ tax benefits through September 10th of this year. So this is time sensitive, September 11th to be specific, according to the slide. And as mentioned, you have more flexibility with a partnership K1. Listed here, 1, 2, and 3 are kind of demarcation lines as to when that gain can be qualified. I want to suggest to the audience that if you have a client who has a partnership K1 gain seeking OZ tax treatment, there are ways in which to qualify that gain. This is some of the detail, but I would suggest that you again reach out to us and we can provide specific guidance. Gabe, do we have another poll question about this point in the presentation?
Yeah, let me go ahead and get that launched real quick. What do you view as the best economic benefit of OZs for your clients? So we have that launched for our attendees. It will be open for the next minute or so. So please get those answers in for us. Once again, I'm here in the Q&A if anybody needs any assistance. And let's just give those a moment to start coming in. All of the above has taken a very large lead very quickly.
Good, very good. So let's move forward to discuss OZ 2.0. And let me reflect on my experience in 1.0. And then we'll draw the comparison between 1.0 and 2.0. I would contend that because the program was originally legislated in 2017, somewhat ambiguous text, required a couple of revisions, and was designated as temporary, the practitioner community did not adopt the Opportunity Zone program as maybe I would have expected. I consider this the greatest tax advantage solution ever provided by Congress. It was still a wildly successful program, but it required a lot of evangelism and education. And that is what we have been doing since 2018. And the adoption was significant, but I think I juxtapose that now with permanence in the tax code, because I think what you'll see here is a powerful tax advantage program is now permanent, and its administration is relatively easy. And I think we're going to see a significant uptick in the use of opportunity zones, particularly as markets are at highs, more M&A, IPO, other transactions occur. This will be something that will be used routinely. And I do think, evident by 1,200 attendees today, the practitioner community is seeking to learn and to apply this powerful tool within their client base. So again, 1.0 very successful. It was temporary, and therefore maybe it didn't get the adoption we all expected. But it also had what I call, decrementing benefits. I mentioned that the deferral period in 18 was 7 years, and then it declined over time. It began and included a 15% step up. That is a discount on your tax, and then soon became 10%, and now is no longer being applied. So these benefits were degrading over time. Again, coincidental with the temporary nature of the program. Again, that program concluding, still in force, but concluding December 31 of 2026. The new program, being permanent, has a rolling deferral period with a rolling step up in basis. So let's get into it. And therefore, I think it's going to be significantly or widely adopted. So the latest in OZs, it is now permanent. It has a new 10-year cycle effective date beginning Jan 1 of 27. So the program does not begin until Jan 1, 2027. 1.0, as I mentioned, still in force. Benefits are still very significant. The deferral period has been reduced. The difference between 1.0 and 2.0, among other items I've already mentioned, include a change in maps. So the 8,700 zones that I pictured earlier in the presentation will change. There are new maps forthcoming based on 2020 census data. And we expect, by our calculations, the number to actually be reduced, the number of zones to be reduced from 8,700 to approximately 6,500. The reason for that is that the AMI threshold has been reduced from 80% of area median income to 70% area median income. And there is a new inclusion of rural zones. So we'll get into that in just a moment, but these are some of the differences now between 1.0 and 2.0. But as it relates to 2.0, new maps, those maps are being devised as we speak, will be in force again Jan 1, 2027. The deferral period, as described previously, which is now limited through December 31 of 26 and 1.0, will be a rolling 5-year deferral. So you invest in 27, you earn 5-year deferral. You invest in 28, you get the same 5-year deferral. You also get to enjoy a 10% step up in basis. In other words, that deferred tax paid 5 years hence will be discounted by 10%, or you pay 90% of that tax. Another incentive. So we get new maps, a rolling 5-year deferral, and 10% step up on a permanent basis. So this is why I believe we're going to see significant widespread adoption of OZ and a convenient, flexible program to apply to any realized capital gain. So comparing 1.0 to 2.0, I think I did discuss the deferral and step up. The step up has expired in 1.0, does not apply. The deferral, as mentioned, is this short window. And that is, we consider that de minimis, but the other two benefits we discussed are very significant. We have well-established 1.0 maps. Some may say some of those opportunity zone designations are surprising. We've been cherry picking across the 8,700 zones. We believe we're able to source the most attractive, highest quality opportunity zone projects. Again, we execute on the program to deliver multifamily solutions. The maps are well known. The maps will change in 2.0, and we're trying to get ahead of that, and to the extent that we can even influence some of those designations. But again, I want to make the point for your clients that have realized gains in 24, we talked about that scenario. Certainly in 25, the program exists for all the aforementioned benefits. You can obtain the tax shield, seek to diversify. The program is in force through December 31 of 2026. Gabe, I'm checking with you. Do we have a poll question at this point?
We do, yes. Let me go ahead and get poll number 4 launched for our attendees. This is our 4th of 5 polls today. Are your clients still able to defer their capital gains tax with the current OZ program, aka OZ 1.0? And that'll be open for the next minute or so. So please get those answers in for us. And let's just give it a brief second to start tabulating those. I don't know has jumped out to an early lead. That's an honest answer. Just one moment, and let's see. Actually, I don't know is pretty closely tied with yes, OZ 1.0 is still effective, but they can defer their capital gains tax until the end of December 2026.
Yeah, so that's really interesting, and let me establish that the combination of the three benefits we've discussed today, when imputed, so that is a short-term deferral, the use of depreciation, and now bonus depreciation being applied without recapture and tax exemption, generally speaking, adds 400 to 600 basis points, or 4 to 6% to the return profile of this investment. Now, the alternative, of course, would be to pay the tax, invest most likely in another taxable investment. We hope for appreciation in that investment, and then realize that gain and pay the tax again. We have a calculator that, Gabe, I think we should distribute, and it's for illustrative purposes only. But it, and by no means, is it a projection. But you can see the power of tax advantage OZ investing when compared to a non-opportunity zone alternative. So we'll deliver that tool to the audience, and you can see the power of this program. And so we believe very much so, and we have actionable funds available to invest in 1.0, and there's many reasons to do so. We've talked about the benefits. We've talked about the maps that are well known, and we've been sourcing since 2018. And so we think that, as you will see, the quality of the projects is very, very attractive. So lots of opportunities still within the Opportunity Zone program. So our execution, this is only to, again, illuminate how the Opportunity Zone is executed on in the context of multifamily real estate. So we have high conviction on an asset type, and I won't go into great detail on build-to-rent communities. These are communities for rent, and we know that home ownership is out of reach for many, as rates have, 6 and I think peaked at 7%. And yet, young families want proximity to schools. They might want a backyard and the amenities of a single-family detached home or even a townhome. And so uh, we sourced 3 projects in 3 opportunity zones in the Southeast to build 467 townhomes in an opportunity zone that provide all the tax benefits and a really compelling investment opportunity around this particular asset type called build to rent, BTR. So we have this actionable fund for anyone that has, again, that 24 gain, 25 gain, and happy to talk to anyone about that. So Gabe, I think we're coming up to the conclusion here. I want to take a look at the Q&A, but do we have a final poll question?
Yes, let me get that last poll question launched for our attendees. How likely are you to recommend OZs as a tax advantage tool to your clients after everything we've discussed today? Again, I'm available in the Q&A if anybody has any questions or needs any assistance there. Please get those answers in for us.
And while we're doing that, I'll trip through the Q&A. I see the first question is relating to the nomination tool for the governors. So let me give you an example. I said we're seeking to influence, to the extent that we can, a designation of zones. I'm speaking to you today from Seattle, Washington, but across the bridge from us is maybe a well-known city called Bellevue, Washington, and we believe strongly in our backyard here, certain tracts should be designated opportunity zone to provide more affordable housing and otherwise kind of upscale submarket. And so we went to the mayor's office, the mayor of Bellevue, to present our point of view, and that was gladly accepted. And so what they will do then is the mayors will make nominations and ultimately the governor arbitrates. The question here is what tool is being used. So I think just generally influence, and of course they need to meet certain parameters as I described, 70% of AMI. If one is looking for in the public domain a glimpse as to what the zones could and should look like, I would refer you to the Economic Innovation Group, EIG, a great resource, and they have now projected the new zones on maps and have a tool for you to evaluate. I'm looking at other questions. Do you guys also do oil and gas or just residential? Oil and gas, I mentioned there's OZ Business, there's OZ Real Estate, categorically the leader in it, and that is exclusively what we execute on. We do not do oil and gas. I have heard of other groups establishing opportunity zones in oil and gas. In the real estate category, although we've selected multifamily for OZ 1.0, we are looking at storage, data centers. We've done student housing, all types of housing. That's certain multifamily affordable. We focused on stadium districts, which were largely opportunity zones. Categorically of the 8,700 zones, I would tell you, many of them are in college towns, and that led us to do student housing. And many were in stadium districts, Denver and Nashville, where we're building multifamily in these new mixed-use master plan communities. So the maps are very, very interesting. Can you compare the rules on or before and after OBBBA? I hope I did that. Specific questions, certainly will gladly respond. Let's see. Capital gain deferral, correct. Are there reduction or elimination components? So as I mentioned, there's that step up in basis, i.e. a reduction of the deferred gain, not applied in 1.0 at this time. The deferral does apply, but no step up in basis. As I mentioned, a rolling 5-year 10% step up in basis. Anyway, IRAs are included. Great question. I will say that because we pursue very high quality real estate, we've had a number of people without capital gains saying, I'd like to invest from my IRA. I'd like to invest non-gains. They do not enjoy any of the described tax benefits. They do get to participate in a traditional high quality real estate investment. We allow for the investment of IRAs, IRAs, and non-gains. Question here, what happens if the project is sold before the 10 years? This is for an investment made in 2017. So you can, best to deal with this maybe offline, but you can sell. You're not precluded to sell in less than 10 years. You may not qualify for tax exemption. What you can do is you can roll over the gain in certain circumstances into another opportunity zone fund investment. So there are ways to work, and we at Pinnacle sold our first, Scott, you're referring to a 2017 transaction. We sold our very first OZ deal. We got an incredible offer, couldn't pass it up in the best interests of all investors, superseded any taxable consequence. And with a proper vote, majority vote, we decided to sell. But we did roll that over into another OZ, which you can do. And again, no hard fast rule that you can't sell in less than 10 years. Generally speaking, the holding period for traditional real estate is 7 years. The program wants to discourage any sort of short-term trading of real estate assets and therefore give that really exceptional benefit for a 10-year holding period. I want to make the point, there's a question here implied, although it's a 10-year holding period, and we're talking about an opportunity zone real estate project, this is underlying traditional real estate. This is real estate that can cash flow income. This is real estate that can be refinanced, and you can cash out from that refi. So we, in our business plan and the way we execute, is we're delivering cash returns to our investors. This is not illiquid. This is a performing asset. And all the same rules apply. It just happens to be an opportunity zone. It just happens that you invested a capital gain. And by the way, the administration of this for all our practitioners is a single IRS form, I believe it's 8879, where you designate and schedule the gain and the associated opportunity zone with an EIN number, which is registered with Treasury. And that is all you need to do to begin to qualify for the OZ tax benefits. A lot of great questions. A question on 1031s. You normally defer. Yes, it's a perpetual deferral. If you sell, you have to exchange again, or the tax comes due. Or if you die, your heirs get the benefit of the 100% step up. Oh, client rolled capital gain from sale of a violin into a New Jersey opportunity zone gain. million back in 2019. So that's a collectible. My understanding is that he'll recognize the income. Yeah, and no additional appreciation. Okay, that's a longer question. Love to talk to that person and maybe provide some guidance. I think in this scenario, the client will have to pay the deferred tax in 26 as required. A fun example, the sale of a collectible violin. Gabe, how are we doing on time? And do you see anything in particular you want to call out before closing?
Well, we do have some time for more questions, and we have had a lot of great questions in this
We
session.
have.
One question I've seen a lot come up, and you may have already covered this, was what is the minimum investment, minimum dollar value investment, or are there any guarantees on return?
So for our investments, we have $100,000 minimum. That's $100,000 of capital gain. Remember, we talked about how flexible the program is. That could be derived from a multitude of sales, not just a singular sale. It could be all or part of any one gain. There are no guaranteed returns. As I said earlier, the tax benefits themselves generate between 4% and 6% of a return, kind of time value money. And we have a calculator, as I mentioned, that will illuminate that. Our projects are generally returning, in this case, the build to rent portfolio is a 15% IRR before tax benefits. And that's a very attractive rate of return. So, with the IRR lift from the tax benefits could be 18, 19% IRR.
So another good one I saw here too is, can the client withdraw funds or partial withdrawal before the end of the 10-year period? And what are the tax consequences in that case?
So I think that you can do that. That's called an inclusion event. And if you do so, you would be obligated to pay the tax. So say, as an example, you invested in 2023, you earned your tax deferral, didn't pay the tax because it was deferred in 23, and then you withdrew the money here in 25, that'd be considered an inclusion event, and you'd pay that as a 25 taxable event.
And so I think along some of those same lines, if you sell before the 10-year, does the 10-year period restart?
If you sell before the 10-year and reinvest in another opportunity zone, and you do it in a particular structure, you don't have to restart the 10 years. So again, worth discussing in greater detail, but certain structures allow you to roll over the QOF into another opportunity. And so there are some really interesting ways to arbitrage this. But I will tell you that yes, there are ways in which you don't have to restart the 10-year term. And then again, I just want to reinforce that in the way in which we structure our investments, again, these are 506 C investments, securities investments. We deliver cash flows to our investors, and then we use that depreciation to reduce the taxable liability. We use refinancing events to provide lump sum return of capital. And we try to do so that the individual investor has the opportunity to repay the deferred tax when that tax is due. And then at the time of sale, of course, there's a big lump sum return and there's no taxation. We've achieved tax exemption at that time.
And we probably have time for another question or two. We have had a lot of great questions in this session, trying to make sure we don't repeat too much content. Can you use single family rental homes, or does it have to be multifamily?
It doesn't have to be any type of real estate. Single family rentals, otherwise called SFR, and our fund today is a BTR, build to rent community. These are variations of the same theme. SFR is typically scattered meaning they can be anywhere. They're not in a community per se. Could be, I own 100 homes in 5 different states, but there is no requirement, again, to invest in a particular type of real estate. We have chosen to invest in multifamily, generally speaking, for 1.0 because it gave, we're underhoused as a nation and there's a lot of demand for more affordable housing. So this is a business decision that Pinnacle took, and this is what distinguishes Pinnacle. But there are people that have done SFR, industrial storage, all types of products, as we call them in real estate. And 2.0 might have Pinnacle doing new product categories once we see the maps.
And one more question here. Are there still FERPTA considerations for foreign investors?
So there is, so one has to be a U.S. taxpayer to earn these benefits. There are treaties, as you know, tax treaties to eliminate double taxation. We've had a lot of inquiries from Canadian investors. They do not, file a U.S. return as a result. So it's situational, but you have to be a U.S. taxpayer to enjoy the benefits of the Opportunity Zone.
All right. Well, thank you so much, Jeff. Did you have any final remarks before we go ahead and wrap things up?
Well, the questions are fantastic. We're obviously dealing with an expert audience, and I hope I've been able to inform you and illuminate the power of this program. I think it's going to be in the toolkit now that it's permanent. I think we're going to see this wide adoption of it. We are an interesting organization that's been executing on this. So please reach out if you have interest in any sort of tax-related scenarios. Again, we don't dispense tax advice, but we've got on the bench experts in this category. We also have actionable funds that can take gains realized today or in 24 and qualify for the tax benefits we've discussed today. There'll be a lot of regulatory work being done in the intervening period. Maybe I should come back and update on the regulatory process. But the framework is done and as described today, and I hope it was valuable to you. Thank you.
All right. Thank you so much, Jeff. We really appreciate having you here with us today.
You bet.
So to wrap things up for our attendees, the handouts, archive of the webinar, and CPE credit will be available in your CPA Academy account within 24 hours. CE credit for attendees with a P10 on file will be uploaded to the IRS at a later date. And if you look in your email inbox after this session, you will find an evaluation link. So please let us know how we did on this webinar. All questions asked today will also be forwarded in a full report to our presenter as well. Thanks again to Jeff for your excellent content and to our members for participating today. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thank you, everyone. Have a great day.